participants coming in today. So we'll just give people a few minutes to gather. We had almost 100 people attend today, so just give them a few minutes to pop in. Hope everyone's having a great day. Thunderstorms here in Austin. It's finally cooled down a little bit. There are no forest fires going on here though, so just pollen in the air. Not.
The temperature been like there?
Yeah, it's we're just hitting our beautiful time of Austin, where it's about 80 to 90 each day. But every time there's a cloud in the sky, it goes down to like 75 or 80. So beautiful.
It's kind of perfect. So we've had, I don't know if you've been seeing all the pictures, but the sun here, the sunsets, they've been crazy. Like the sun looks like it's a red fireball because of all the smoke.
Yeah, we had the Sahara dust roll through here, but not thankfully no wildfires. Yeah. Missed them all in Colorado. And yeah, if you're just joining here, we're waiting a few more minutes here for everyone to pop in. We'll probably get started at about 2:03, 2:04. And we're just going to talk about multifamily today and then some advantages of passive investing in an IRA. And please excuse the giant gaming headphones. My audio on my laptop was not working too well, and these are working great. So
you're giving away all your secrets, Brendan.
Yeah.
What you do in the evenings.
They're multi-duty. All right, and what number are we at, Matt? I can't really see the participants right now.
Let's have a quick look. About 30, more people joining every second.
Okay, and we'll wait about one more minute and then kick things off.
I think, yeah. Yeah, there's like every minute, you got another batch of people.
Yeah, so typically at Rocket Dollar, this is just interesting for the audience as well. We have about half the audience. If 100 people say they want to attend, it's usually somewhere around 50 or 60. So it's interesting how many, the other people want to catch up on the recording. But there's just been a lot of self-educating going on this year, just obviously with people bored out of their minds or just trying to learn more stuff, trying to get involved in the markets, obviously with the stock market so hot and frothy. There's a lot of people looking for other alternatives in real estate here. So all right, I'm gonna get started here. So my name is Brendan Walsh from Rocket Dollar. I work in our business and sales operations here. If you hit the 855 number on the phone, I'm probably going to answer. Just like to help customers learn about self-directed IRAs, our self-directed solo 401ks. But Rocket Dollar does not provide investments. So one of the things that we do is we lean on our partners to say, hey, our partners provide investments. We also love to work on co-marketing and education with them, saying let's get through that education gap. A lot of people have experience in stocks, bonds, ETFs. They may have done a real estate investment or other types of alt investments in cash, but have they never done it in a retirement account? Or maybe you've never done a real estate investment before. So Matt and I got talking a few months ago. We just thought they have a great presence in multifamily out there in San Diego, investing across the country. I'm going to quickly introduce myself here, and then I'll let Matt introduce himself. So I come from Chicago, from the financial advising industry there, graduated from the University of Wisconsin. I moved down here to Austin, Texas when our CEO, Henry Yoshida, was starting the company, really trying to attack the self-directed industry, see if we can make fees cheaper, bring up the technology here, and just bring up the overall experience. It hasn't really caught up to the standard financial technology landscape. And I'm going to let Matt here introduce himself from CalTier Realty in San Diego.
Thanks, Brendan. I appreciate it. So Matt Belcher here. I'm in sunny and smoky San Diego right now. You can hear from my accent, I'm actually a Brit. I've been in the US 10 years. This will be my 11th year. And my background is I actually didn't start out in real estate at all. I was a management consultant. I was working across Europe, mainly with the oil and gas industry, selling oil and gas compliance management software and information is actually my background. And then as I sort of moved out of that and I moved more into management consulting, I started to get involved in large contracting deals, and then that moved into real estate and large real estate transactions. So in the last 10 years, actually since I've been in the US, I've been involved in the EB5 market, which if any of you come across that, that's the foreign investment market. So we're very foreign investment focused as well, and domestic. And so that's a lot of ground up. And then CalTier Realty, which we're going to talk about, is really an acquisition company. So acquiring cash flowing multifamily assets.
Yeah, and so obviously single family home investing is a big section of our customers, but multifamily is by far one of the biggest real estate products that our customers look to. So I'm going to let Matt, he's going to take over the slides here. He's going to show you some stuff about multifamily. Real estate is kind of just one of the bread and butter of self-directed retirement accounts of people trying to look for diversification outside that stock market, some income and some diversification across real estate markets in the United States. So Matt, you can take over the share screen and I'll return to my slides later. Let me, I'll kill my share. All right, you take over.
Okay. Host disabled attendee screen sharing. Okay. That's fun. I'm getting a host disabled attendee.
Okay. Yeah, so I'm host here. Matt, just give me a few seconds. I'm going to pull up your slides.
Oh, you got to put me back on. No, you can.
I'm just going to click through you. Just 1 second, everyone.
Okay, because I actually updated those slides.
Okay. Here, let's give it back to you. Make host. All right, nice and easy. Zoom's got it.
Thanks. All right, so let's do that. And give me 1 sec, folks. Okay, very good. All right, so let me go into full view for everybody. Okay. Well, again, Brendan, thanks so much for having me on here. I really appreciate it. And you know, we're excited at CalTier here to be partnered with the folks from Rocket Dollar and be on their platform. And for those of you watching, you know, if we can help you with your investments, then you know that's a win for us and a win for you. So you just close that down because I'm getting pinged on Messenger. So real quick, I do have to say this disclaimer. I know it's boring, but my attorney will cut my hands off if I don't. We have an SEC qualified Regulation A fund. You can see that at caltierrealtyfund.com, and you can read the offering circular on the SEC website. So I have to get that little bit out of the way. I'm going to take a minute or two just to tell you about CalTier so you have an understanding of who we are. And then I know we really want to talk about real estate and acquisitions. So that's what we're going to jump into. But we're a prop tech startup, essentially. I guess we've moved away from being a startup now to really a growth company. But we've actually raised several seed rounds, successfully raised seed rounds. We're now into a first level senior round. We have our SEC qualified Regulation A fund. We're generating revenue. We have partnership firms. We're a partnership with firms that have access to over $10 billion of multifamily. We've already done some acquisitions ourselves, which I'm going to show you, because I feel like it's important to show real world examples rather than just talk about it. And we have a Reg D and Reg S international investment fund going live, and we are working on our mobile app to allow people to easily just invest from their app. Unfortunately, there's my ugly face on one of the slides and two of the other founding partners. And we have a pretty extended team of real estate and marketing and asset management team. So the key, you know, what we're trying to provide here at CalTier is the ability for anyone actually globally, domestically here in the US and globally, to be able to invest into cash flowing real estate assets. So we're combining the property and the technology side. Let's talk multifamily. If if you're somebody here, and I'm gonna bring up the chat. If anybody wants to, feel free to ask questions as we go, and we'll try and answer those as best we can.
Y- Yeah, and if I see a really good question, I'll just speak up and stop you, Matt, and we'll try and address that.
Perfect. Thank you. Okay, great. Yeah, otherwise I'm going to have to keep going back and forth to that screen. So depending on where you look at and depending on the information you go to, you're going to see different numbers. But I want to stick on this slide just for a minute or two. So let's talk multifamily as an asset class. Now, I know most people here on this call have probably invested in their own single family home. They may have gone after an investment property, whether it be a condo or a house, whatever that might be. So you've been through that process. Now there might be people on here too that have tried to go for multifamily investments, or you may even have invested in one of these club deals or these group deals. So I know there's different levels of experience here on this call, and people have a preference to the type of investment they go for. So what I'm not going to do on this phone call, this webinar, excuse me, is tell you that multifamily is absolutely the best investment that you should go after. Do I think it's incredibly strong? Yes, and we're going to talk about that. And I'm going to tell you why we as a company are primarily focused on all of our investment opportunities are either multifamily developments or multifamily acquisitions, so acquisitions of an existing cash flowing asset. Probably one of the biggest reasons is the demand. So I don't think any of us have a crystal ball of what's going to happen. We just saw the Fed said they're going to keep interest rates relatively low, or on the floor, actually, lowest they've been historically. It's a historic moment that if they do keep those rates down there, that's unbelievable. And that's going to, we'll see what happens with that, right? Will that fuel the economy? We don't know. I think that's the intention. I think there's also a risk that it's going to create a massive debt burden. We're already lent. I saw that debt is already bigger than it's been for the last 50 years. So I don't know if lowering the interest rates is necessarily going to stop that. I think it's going to increase that borrowing. So we'll see what happens in the housing markets. But we know for sure, or we know as sure as we can be, depending on where you go, if you go to CBRE or, for example, here, the National Multifamily Housing Council and the National Apartment Association, they say that 39 million people live in multifamily, and that need is going to grow, right? So who knows if it's going to be 14, if it needs to be another 4.6 million units, or as they say here, 325,000 annually by 2030. But it's a large number, right? Depending on which state you're in, house prices are going up. People tend to, the mindset is much more focused on this kind of renting mindset. And the biggest thing we think is, that 82% of millennials said renting is more affordable than buying. And so we do have this, if you're looking at you look at a hose pipe, you've got a bowling ball going down that hose pipe, right? And that's that millennial kind of movement. So we definitely feel here at Calterre that multifamily is a very, very strong asset class to go after. So just to set the scene on that. A couple of reasons, also, a couple of kind of the bullet points of it. Most of this, the assets we go after are cash flowing. So liquidity, so as a sellable asset, you're selling something that's cash flowing. They're normally leased up. We normally try and aim for 92+ percentage of the asset to be leased. There's always that kind of in and out percentage, but that's roughly what we're after. Like I said, the demand and trends, we don't need to go into that too much. You can risk adjust your returns depending on the rent roll and the economic drivers. There's an abundance of debt, Fannie, Freddie. So we leverage these things typically 75%, right? So when we get into, in a moment, when we talk about the investment that you might be interested in making, the other 25, that's where that goes, right? So the 75 is all debt, and that gets provided by, let's say, Fannie, Freddie, or another bank banking institution or an institutional partner. Regulatory support, again, almost every major city has identified the need for more affordable housing. We live and breathe that here in California, that's for sure. Your risk is spread over multiple leases within one asset. So if you're a homeowner or you own a second home and you're renting it out, you can make a lot of money doing that. But your risk is always that you've got that one person in there with that one lease. And you can read the others, but I think the one I want to point out the most to is the transparency. So cash flows can relatively easily be managed and analyzed. So we can really forecast out over 3 to 5 years. Now, even let's take COVID as an example. We have an asset right now that's in Texas. We actually had, we acquired it at the end of last year. Then we had COVID hit and there was a fire in a few of the units. COVID and the fire in a few of the units would, if you're a home or an office, it may take that asset down. Now, it certainly put a dent in our cash flows, but it hasn't, the long-term projection of that asset hasn't really changed because you've got, multifamily, you've got multiple basically leases in there. So there's some of the key reasons. So let's, I'm trying to keep this fairly condensed for everyone because I know Brendan has some questions that he wants to go through as well. And we want to talk about how you invest. But let's talk about real estate generally. So identification can be difficult. We're all really busy. Unless you're a realtor or unless your passion is real estate, you have to spend a lot of time on Zillow, on the MLS systems, driving around. I don't know if any of you are familiar with Robert Kiyosaki and his cash flow books and the cash flow quadrant. But when I read those 15 years ago, something that hit me was he always talked about in real estate, you look at 100, you literally analyze 100. You put an offer in on 10, you get counted on 3 and you buy 1. So 1 out of 100 invest, what you're investing in. You got to know your market well, right? We do invest across the country, but when we do, we normally do it with a partner. We're based here in California. If we're investing in Texas, we're going to work with a partner who's on the ground and knows that area intimately. Banks require a personal guarantee. There are high brokerage fees. Realtors work very hard, but they also get paid very, very well in this country. I believe the US has the highest real estate fees in the world, is my understanding. So good for you if you're a realtor. It can be hard to secure debt. Very often it's to do with your job and your net worth. And you've got to look at the returns. I actually had what we call in the UK a flat in London. And at the end of the day, I made money on it over a 5-year period. But actually, the only money I made came in the last 2 years. The first 3 years, I had, the water heater broke. I had to replace the kitchen. I had to do a whole bunch of stuff to it. So yes, I did make money from it, but honestly, that was not from being smart. It was a little bit of luck. So you really got to figure out, if you're doing single family homes, that type of thing, is that really worth it? Commercial grade investments are even harder. So very often these things aren't on the market, or when they're on, they go very quickly. Very high brokerage fees, typically with commercial real estate. And I'm talking cash flowing multifamily. So a lot of the deals we are presented with aren't actually even on the market. So, there's a sort of a private network where sellers will reach out to buyers with the ones they know can actually do the deal. So you may not even see it. And I'm talking 30 units and up, 30 units up to, 500 unit multifamily investment. It can be hard to secure commercial debt. Somebody ultimately has to sign on the line. So you need a very large net worth to be able to do that, sign the carve out, as we call it. Large deposits, 25%. So you get 75 debt, 25% in cash. And you need asset management. You need property management. So the leasing office, looking after the gym, looking after the pool, all of those things that go into looking after an asset like that. Then you need the asset management, which is the level up where you're managing the finances of it, the distributions to the investors, and so on and so forth. So it is tricky. There's a lot to be done just in acquiring one multifamily asset, and even if you can get your hands on it. So that's what we do through us and our partners. One, we source and underwrite, we negotiate and acquire, we put the financing together, we do the construction and rehab management. So that's the value add. So we'll look at an asset that is in an area that has economic drivers that we feel that when we go in and we do the renovations, we can lift the rents to the level that market will sustain. So possibly there might be, let's say there's a new development went in down the road and they're at 90% leased with a brand new asset. What we'll do is we'll pick an older one, we'll go in, we'll acquire it, we'll do the construction and rehab, and then we'll lift the rents to get close to where they're at. We also do the ongoing asset management. We do transparent investor reporting through our platform. And then ultimately, we want to sell this. So the disposition of the asset, and selling a multifamily is actually the same amount of work that it is buying, because you have to work with several buyers and we have to make sure that they have their capital put together and that they are going to be able to take this on and manage the asset in a professional manner. So Calterre Realty's fund, our Regulation A fund, enables you through your Rocket Dollar platform to be able to invest into our fund, and then our fund distributes that money across a portfolio of assets. So we're doing all the things that we talked about up here on the top, through 1 through 6, and you're investing. It's technically a passive investment into our fund, and we're doing the work on your behalf on the back end. So it's through our technology, our relationships, and our funds, you kind of have this relationship as we talked about with Rocket Dollar, but also our real estate relationships, and our funds and then our technology provide a seamless solution for the independent investor to deploy capital in the US. An example of one of our real estate investors partners is Sundance Bay. They have acquired over 4,500 units, and they've done about $4 billion in combined acquisition and development experience. So we partner with them, and I wanted to show you that. So here's an example of one of the assets that we partnered with them in, and this is in Glendale, Arizona. As you can see, it's 352 units. And so this is a really typical asset that we would go after. It's built. It's sort of, it's built in 1974. It's probably been renovated a couple of times. It will need more of a renovation. You can see the pool there. This is renovation where we go in. We may expand the pool. We'll probably put in more dog facilities, for example. And this was a $30 million asset. What we do when we raise money for these assets is we put in the renovation costs into the capital expenditure. So it's all built in. So we don't acquire it and then have to raise money to do the renovations. I think that's a really important aspect here, is that the capital we put together and structure includes the rehab costs to do the upgrade to the asset. All of these investor returns are obviously projected. There's no guarantees with the returns, but we forecast about a 1.8 return on investment, and that equates to an IRR of about 16 to 18%. So the average cash on cash with this investment is 9%. So just wanted to skip back here.
And one quick question that we had a question come in. So Mr. Borden was asking, multifamily in the past decades has been attractive, if an institution wants to drive the cap rate down.
Yeah.
What do you consider a good entry level cap rate in this market?
That's a great question. It really depends on. It really depends on the. Can you? I can't see the question. Can you ask him which?
It's in the Q&A section. So it's just saying, in the past decade, institutions have been driving cap rates down tremendously. What do you consider a good entry level cap rate in this market?
Right. Could you just, would you mind responding saying which state is he asking about? Because the location makes a big difference.
Okay. So maybe let's say Texas just to keep the flow going, and we'll go from there.
Okay. So you're looking anywhere between 4.5 and 5. You know, California's very different from Texas, and it's also very different from where we were in January. You know, I'm trying to think of, I was reading something recently from CBRE. The average cap rate right now, I think on multifamily is about 5.2 to 5.5, something like that. So that's a great question. Yes, they are trying to drive it down. And it really, you know, we are seeing cap rates are different from, like I say, from January to they are, you know, today when we sit here in September. So you know, the average is about that 5 to 5.5. We, you know, if we can get to, you know, a 4.5 to 5, then we're you know, that would be a, depending on the location and depending on the asset, that would be, you know, an ideal situation.
Great. Thank you for answering that. All right.
Okay. Am I good to keep moving?
Yeah, go ahead. Keep moving.
Okay. And if I'm moving too fast, Brendan, please tell me. I know I just wanted to get, you know, I wanted to get as much of this out as quickly as possible.
No,
So
it's all good. And I think that's really interesting about the different state and markets, you know, the different state variants there. And that's something, you know, an experienced manager is obviously really in tune to. Otherwise, you got to be doing a lot of deals in your home state to be aware. Or especially if you're going out of state, you know, if you're not familiar with your area, you're walking into a whole new market that you might not be familiar with.
Absolutely. And I just, one of my acquisitions guys, he's obviously watching this. He just texted me some data. So let me maybe read this out. And that's, to your point, that's exactly why, if, you know, we know Southern California, Northern California quite well, we know Arizona well, but if we're going into Texas or Florida or wherever else, we're going to work with a partner. And so here's an example. This is, and also it depends on the class of asset, right? So Class A is very different from what we normally go after, which is Class C. We try and take things that are C- to a C+, maybe. So for example, if let me give you just a range here. So Boston right now has a range for stabilized properties on Class A of between 3.75 and 4.75. So there's a huge range. But if you go all the way down let's see, Class C, you know, you're up at the 6. So that's just Boston. So we really got to look at the locale and then the class of asset. And then, you know, I'm even looking here on this info he just sent me. So I've got, you know, for example, they define Oakland, San Francisco, and San Jose as like they've got their own segments. So even in a, you know, when you might, someone might say, what's a good cap rate up in San Francisco? Well, you got to say, well, are you talking Oakland, San Francisco proper, San Jose? Are you talking Class A, Class B, Class C?
Mm-hmm. There's so much locality to it. And can you quickly define for our listeners what a Class is and how a Class C property opportunity might differ?
Yeah, absolutely. So everyone has a little bit of a different view of it, but you know, so a class. So let's kind of take it down in a notch. So a Class A asset would be, you know, in a gateway city. It might be in downtown Los Angeles. If we talk multifamily, it would be a premier apartment complex or an office building, for example, and it's going to be in the top sort of 5% centile of costs. So you know, it's going to be, if you're an office, it's going to be at the top end of the cost. It's going to have certain facilities. On the multifamily side, you know, you're going to have a top rate gym. You're going to have maybe a cinema room. It's going to be a beautiful asset. We have one here that just got built in San Diego. If anybody knows San Diego well, there's an area called UTC near La Jolla. And what I'm about to say might make your eyes water a little bit, but that apartment complex, for a 2-bedroom apartment complex, probably, I don't know, 1,200 square feet, is $5,000 a month. So, you know, that's a Class A asset. And then you're moving down, you know, a Class B asset, if it's not new, will be in a slightly lesser area. You know, and there may be an age component to that too, and facilities. And then Class C is what we go after. So typically this is going to be in, and we call it workforce housing as well, right? So the type of person that's going to be in there has some kind of steady job. They may have 2 jobs. There may be 2 people working in that are in that one unit. It's going to be an area where we feel that there's an economic uplift. So it's, you know, it's not going to be in a major area with major, or it wouldn't historically been placed in an area with, you know, it's not going to be in the downtown Los Angeles or on the port, for example. So the economics of it drive the class of that asset down. I actually have we have a really good explanation of that, which I can send out if you want to forward that on. And I had that slide in my presentation, but I took it out.
Okay. Yeah, that's all right. And I just love the conversation so people can visualize properties around them. Obviously, you can see the different classes of real estate all over Austin, just visually as you're driving around the city. So kind of love that conversation, that interruption. It was a good sidetrack there.
Super. Yeah, no, that was a great, thank you for that question. The gentleman who asked that. You know, also, the other thing is, if you talk, you know, I'm one person in the industry. If there were 10 of us sat here, we're all going to, whatever the answer we give you, I guarantee 90% of it we'd agree on, and the remaining 10 we'd have a difference of opinion. So, you know, so it's across the board. So, you know, example, Sundance, I think I was talking about Sundance. So they're a very strong partner of ours, and this was one of the assets that we went into with them. That's actually the end of my slides, Brendan. I wanted to keep it pretty succinct, but I'm happy to expand on anything that you would like to. What you think?
Yeah, that's all right. I love that sidetrack. I just wanted to get you into that. So you can throw the host over to me. I'm going to talk about some benefits of passive investing, which, you know, obviously the multifamily theme here. Okay, I'm a host now. Just let me clear out the chat. And you can watch the chat for me. All right.
Did my screen stop showing? Yeah, there we go.
Yeah, there we go. All right. Oh, not sharing, presenting. All right. There we go. All right. So, you know, again, who is Rocket Dollar? There's a couple different types of self-directed IRA providers. There's some that directly custody an asset, meaning that custody trust company partner actually goes out and would buy a share of Calterre Realty for you for benefit of your IRA. That's been a successful model, but we feel it's been kind of expensive and a bit cumbersome for people. You know, you have to go back and forth. You have to make sure they approve every single Calterre fund. The great part about what's called checkbook control, where the IRA LLC model is, once you create an IRA LLC, self-directed IRA at Rocket Dollar, a lot of buzzwords here, but once you create a Rocket Dollar account, that can directly start investing in a Calterre opportunity. You can go out and grab any real estate opportunities that you so see. So it is an IRA, a Colorado LLC. We do that for all 50 states, and a bank account. And that bank account allows you to go enter an investment directly. You can sign paperwork, and you can also approve the wire. So our customers, if they see an investment, if the closing is in 2 days, they can jump on that. They can start signing the paperwork. They can send a wire. We do also offer a direct IRA. We're trying to bring some efficiency there as well with our premium pricing, that for our California customers. So this IRA LLC works fantastically in 49 states. A lot of our customers really love it. When it comes to California, they tend to tax any LLC that breathes there $800 a year. They don't care if it's in Colorado or domiciled there. They try and tax it. But so that's just something to keep in mind. As a passive investor, you don't have to worry too much about the California issue unless you are directly living in California. Okay. So what are the advantages of passive real estate investing in an IRA? It's something to avoid a lot of possible hassle. So sometimes people talk about buying a single family property in an IRA, but it can lead to some of these issues. The people that love to do that, they love to work really hard in that hassle, that control, that's great for them. But for a great majority of investors, it's just really simple to go into a passive investment like this, multifamily, get diversification into real estate in a number of assets. So it's a simpler investment experience. You deliver your check to Calterre. You're kind of trusting them, say, hey, I'm taking a risk. Obviously, every investment has some risk, but I'm investing with you. I'm investing in these properties that they're managing. These are going to deliver me a check. You don't have to go visit this property. There's a lot of prohibited transactions. This is a learning curve in the self-directed IRA. A prohibited transaction is basically just doing a violation while you're investing inside of a retirement account, because they're a bit more free form of a retirement account. The pro is they allow us to invest in all these different asset classes. The con is there's just a few more rules that you have to keep aware of compared to the New York Stock Exchange. Doing a non-recourse loan or a hard money loan, or what people think of as a mortgage, it is extremely important that all lending that your IRA directly applies for is a non-recourse loan. A lot of real estate people call it a hard money loan, and I will get into that. It makes the things a little bit more complicated. And then there's UBIT and UDFI, which I kind of consider the boogeymen of self-directed IRAs and real estate investors. This is the reason you're going to a retirement account is you're going to save taxes. You're going to put in a traditional IRA or Roth IRA. You're going to get great tax treatment of your investment. However, UBIT and UDFI, these are a couple taxes in real estate in self-directed IRAs that you just have to be aware of. Great part about passive investing, it avoids them. So I'm going to get into all that here. So just some really quick pros of passive investing, versus active investing. Passive, you fire and forget it. Obviously, you don't want to forget and never talk to Calterre again, but you put your investment in. You're letting them handle the investment conversations. You're letting them handle the management. You check your statements. You hope that they're doing well with your money, but you don't have to be so involved in it on a daily basis. You get to work with an experienced manager, like Matt just talked about. He's using experience. Their team's going out and using experienced partnerships whenever they go to the state they don't know, or their team obviously knows California and the Arizona area well. No hands-on visits to properties. If you are a self-directed investor of a single-family home, you can visit your property as a manager, but you really cannot be swinging a hammer. So it creates this weird dynamic of people want to go to their retirement properties and they want to see them. They want to make sure they're doing well, but a window breaks, something in the kitchen breaks. Is the IRS going to care if you repair, you sweep up once? No, but if they find out that you built a whole addition on your house and remodeled the kitchen, they can be very frustrated. They can give you a huge penalty, basically death penalty to your IRA. It's a huge violation. So again, staying on the passive invested side on the left, your management is already hired here. Everything is taken care of to manage the properties that you're invested in. You don't have to directly talk to tenants, which is another theme of multifamily that Matt was talking about. The tenants are taken care of. There's someone sitting at the apartment office handling tenants, getting renters, dealing with their problems. Someone's talking too loud. The police were called, a fire, roaches, etc. That was an apartment in Austin what those poor ladies were dealing with. And the pool is closed and everyone's mad about it. So more diversification. You get to diversify, multifamily, diversifying across many tenants, and then in a fund like this, all across the country or different opportunities across the state, etc. And possibly more liquidity for your fund. So if you're owning a property, that money does not get access into your IRA again until you sell that whole investment. So it allows you to have a lot more liquidity, get possibly to enter another investment, or you say, hey, these things aren't working out for me. Obviously you will sign that contract with the fund at the time, and you will clearly know what your liquidity constraints are when you start the investment versus being at the mercy of the market. So active investing, I'll just quickly go over the single family property owner. For some people, that they love this, but it's got a bigger learning curve. You got to hire your own manager. It's kind of that like passion and that hassle that people love to hate. It gives you more control over your property. You do get to pick your property. You're paying some lower fees, and if you do have this like very good knowledge in this area. But as Matt was saying, once you start to get out of your silo of your neighborhood, unless you're a realtor or unless you kind of know the wider market in your state, it gets a lot harder to be picking as much as an expert real estate investor.
Hey, Brendan, I didn't want to interrupt your flow, but we had a couple of questions if you want me to.
Sure.
Okay.
Let's address some of those.
Okay, so Adam asked, but I think you may have covered Adam's, but he said, my understanding of Rocket Dollar was that you can invest in your own real estate as an active investor.
Yes, you can. So the reason that I'm doing this part of the presentation here, you can still do this. You can still invest in a single family home. And I just said we have two constant types of real estate investors. We have the people that absolutely love single family homes. We have master passive income. He's a partner. He does all this education. But that is a very specific type of personality type, and it takes a special type of investor. Some people have great success with that investment. A lot of people coming in for their first real estate investment to Rocket Dollar, they look at that and they start hyperventilating a little bit, and they realize what they're getting into, and they go, wow, I want real estate in my IRA, but maybe it's best to stick to passive for my first investment. So yes, you can do both of those. I'm not trying to knock and totally knock single family home investing. You can do it. It's just a very specific personality type. And I have some people on the phone that talk to me and they get a little scared of all these things that I'm talking about. And this is just a presentation. Hey, passive investing, this is how you can avoid some of these headaches. Is there another question?
There was. So Adam just did a quick follow-up, and then there's one more from somebody else. So he said, can I be an active investor in multifamily? You only mentioned single family.
Yes, so you can be an active investor in multifamily. So this is something that even relates to Matt right now, is that he's talking about these partnerships, investing with other people. We have sometimes at Rocket Dollar, someone will say, I have a group of 25 investors. We're trying to go into an apartment complex. You can do that in a Rocket Dollar account. You can have 20 to 30 LPs go into an investment, into a multifamily or to a property investment. You can work with someone like Matt and Matt's network, work with financing and work through that deal network. So you can have 20 to 30 Rocket Dollar investors go into. So maybe, 15 or 20 of them are cash investors and 20 of them are IRAs. As long as you structure that correctly, you can do that and work with the multifamily network.
And in that scenario, Adam, the assets we go after. So yeah, we have this Regulation A fund, right, which you can invest into, and it's very, very passive. But if you did what Brendan just said there, that that entity, whatever that is, that structure, which I'm not going to comment on because I'll get it wrong. But that entity, whatever that structure is, can invest side by side into our assets. So there's a number of ways that it could be put together. Justo asked, can an IRA LLC be incorporated in any state?
Yeah, so ours always defaults to Colorado just to keep it simple for every customer because there's a lot of variance. However, if I go back quickly to this structure, I'm not sure, I hope you can see my mouse. Sometimes people will open like a California LLC or a Texas LLC in between here. You consider the Colorado one as like an umbrella for all your investments, and they might open a
Mm.
Texas LLC before they enter an investment. Um, and on the flip side, like the other gentleman was just asking, sometimes they'll say, hey, I have an LLC in New Jersey and we have 30 investors in it. Your Colorado LLC can become a part owner of that. Let's say it's a real estate startup or something like that. You can become a part owner of that LLC in New Jersey. So you can go both ways. You can kind of go into a simple fund. You can help organize a fund together. There's a lot of different ways to structure the LLC. The reason we use the Colorado LLC and the same structure is just to keep it very simple. Product, like McDonald's, make it very simple for each customer, very flexible structure that they can flex their muscles and use in a lot of different creative ways.
You're getting a lot of questions. You want me just to fire them at you?
Um, I would love to. Are they all about LLCs? Or I'd like to move on a little bit just to get through stuff, and then I can answer them all at the end.
Okay, let's do that. Yeah, they're
Yeah,
LLC related. Yeah,
yeah. Okay. All right. Yeah. And I can answer LLC stuff after this call too, because we can kind of go all day on that stuff. And I'll get some more at the end here. So prohibited transactions. These are I started getting into these. There's the rules that you have in your IRA. It takes a bit of a learning curve to learn these. Once you learn these, you can go into a lot of different investments. So if you learn all of these rules, you can enter with 30 investors. You can work with Matt's network. You can, hey, maybe your property can work somewhere in that network. But at the beginning, say, hey, maybe stick to a fund, get into an investment if you're not familiar with these. So what are some common and prohibited transactions when you're dealing with active real estate investing in an IRA? Passive investing usually avoids these. The biggest one, self-dealing. The act of, bringing your personal situation too close to your retirement account. The IRS sees a conflict of interest there. Working on your own home, absolutely zero, no sweat equity. You can be a manager, you can walk through, but you really should not be doing any actual work or swinging hammers. You should always be hiring an army of contractors, someone to clean an Airbnb, something to manage your multifamily property, etc. And that's something like a fund protects you from. Dealing with family or close business partners. There are a lot of people, brothers and sisters are okay in an IRA. There's a lot of cousins that are okay in an IRA. Generationally, going up to your parents or down to your children is almost always a no-no, also with your spouse. There are certain ways to invest with those people, but you have to use a specific structure. You have to be very careful how you do it. So you should keep this in mind if a very close family member or a close business partner, maybe you own a business together, asks you to invest in a real estate investment with you. If you own over 50% with something, should never do it. If you're between 10% to 49%, possibility. If there's below 10%, you're usually in the clear as long as they're not someone in your family. This is a constant one. Someone has a vacation home, they have a second home, they love the property, it's beautiful, they're gonna make money on it, but they want a vacation in it, or they wanna live in it 6 months a year, and then they want to invest in it right out. It's a huge no-no. You can do that in cash investing. It is a big prohibited transaction in a self-directed IRA. That's why, multifamily is constantly more, it has that attraction in a retirement account. And the last thing, crossing over personal dollars and retirement dollars. Someone that's experienced it, has been doing retirement investing for a long time, they don't really have any issues with this. But sometimes I talk to a lot of people, they're really good real estate minds. They fire on all cylinders. They work in the realtor network. They have a lot of contractors they work with. And maybe they make a payment out of their personal account to pay a contractor, or they just, they're new to retirement investing. So that can be a pitfall. If your dollars cross over between your IRA and your personal real estate and your retirement real estate, you can hit a huge issue, and that's a very blatant prohibited transaction. And that could be a death penalty for your IRA, where they shove it all out and you have to pay all the taxes on that. And as I've said before, we kind of talked about, totally possible in a single family and IRA. Not a lot of providers will allow it. those direct custody providers don't like to deal with it because of these issues. We allow it at Rocket Dollar with our IRA LLC structure, but we also have to make sure, hey, our customers understand this and they're not going to blow themselves up in their retirement account. Okay, so how does a mortgage work in a self-directed IRA? Everything must be non-recourse or hard money. And what that means is basically, no personal guarantees. Your personal home, is a second home, a car, personal assets, credit, a business. A lot of these things cannot factor into getting a non-recourse loan. Obviously, your reputation, your ability, that will still have some factor in how successful are you getting these loans, but it cannot be part of the official loan agreements if this property goes belly up, that the lender has recourse to take from you. So that really changes. You need to get it from this loan from a specialized dealer. Local banks often do not understand what a self-directed IRA is. It's no fault of their own. I did not know what a self-directed IRA was before Rocket Dollar, but you need to go to a hard money lender that has dealt with IRAs before. And usually rates are also a little different. So we know rates are really low right now, but it's a different risk level for the lender to take on since it's obviously non-recourse. So they'll be usually a few points above the current market rate. Sometimes people ask, the rates are so bottom low right now, I'm not in tune with what the going hard money loan is, but again, it varies a lot by area, risk, property that you're going after. UBIT and UDFI tax, and oh my God, please, the questions, I know they might come rolling in, but this is always one of the most complex self-directed IRA topics. Not all passive investments are free from UBIT, but there's a great amount of less risk of running into UBIT with passive investing. And this drives a lot of self-directed IRA and solo 401k investing decisions. What property do I invest? Am I going to get hit with UBIT tax? Does your fund have UBIT tax spit off from it? And so what is it? It's basically business income tax, in a place that is tax exempt, but the IRS feels you should still be paying taxes on it. So they had this thought of, what if people hide very big businesses inside of a self-directed IRA? That's an issue. The IRS does not mind a few people investing in their retirement account, making a nice return, hopefully doing well. That they have commented many times that self-directed IRAs, they're legal, have many case laws supporting them, but the IRS really does not want a business hiding inside of a self-directed IRA. All right, so how does UBIT actually affect investing? So some of the same stuff on here, sorry, UDFI tax. So when we come to UBIT tax, what is the most common type of UBIT tax? It is UDFI. It is unrealized debt finance income. And this usually comes from someone taking on a property and taking on leverage. You have to fill out a tax form called the 990T. We have a specialized CPA we send people to fill this out. So unfortunately, someone at Rocket Dollar cannot fill you out for you. We are not tax accountants. It is a very complex tax form. We're not going to sugarcoat it. And this is why, again, this theme of passive investing, multifamily. Some single family investors get super jazzed up to do a single family home, and they have everything ready to go. And then they hit the leverage and they see they're going to get UDFI, and then they back off. And then they go, wow, this really changes. Because UBIT tax can get very high. It can be as high as 37% if you have a lot of leverage on a property. So again, how do you get UDFI? The most common one, someone gets a home, gets a non-recourse loan. They're very high levered out. They only put a little bit of cash down. So they're having to pay all of this unrealized debt finance income tax each year until they get rid of that loan. So these investors try and pay this off really fast. Some complex debt structure funds, so I said, not passive funds usually don't have a UBIT or UDFI. Sometimes if there's a complex debt structure, you're seeing, they're doing all these presentations on complex debt. Sometimes that can get passed off and kicked out to IRAs. So that's something you always have to ask to your real estate funds and make sure they know what it is. Some funds can plan around it, but it's really hard to pivot a fund that's already active, that already gives off UDFI, and see if it, make it not give off UDFI. So how do you avoid UDFI? Are the solo 401k? It's very popular with real estate investors. It can do a lot of different types of contributions. It can do Roth in the same account, like different buckets inside the same account. It's very high contribution limits, and it is exempt from UDFI. So just to have the little guy here, why is it exempt? The IRS says so. There's really no explanation for it. We have a patchwork of laws left over by Congress and the IRS. And so again, how do you, in a self-directed IRA, you are subject to UDFI, and you have to make sure that you won't be hit with that, and you understand that when you're entering an investment. So again, how do you avoid UDFI? Passive investing. The great majority of passive real estate funds do not give off any UBIT. A smart fund can also plan around it, and there are exemptions for real estate funds so that they are not subject to UDFI tax. So again, just quick review. We're hitting an hour here. I love that we've had a great discussion, great questions. We're going to jump into those. Passive investing, it's a simpler investment experience. You avoid these prohibited transactions. You avoid having to deal with mortgages, and you also avoid UBIT and UDFI, which some investors, they are ready to jump full force into this and get their single family property, but passive investing allows you to avoid all of these pitfalls. All right, great. This is just our pricing here for $360 and $15 a month, or for $600 for a gold account. That's for the California investors. If you want that no LLC account, you can go for the gold account for $630 a month. We also have $50 off with the code CalTier. And we'll hop into questions now.
Fantastic. I've got three here. By the way, my head's spinning a bit, Brendan, because I was learning as you were speaking.
Yeah.
There's a lot to it, right? Yeah.
There's a lot going on, and the great part, like I said, the reason I showed all that is because a passive multi-investment avoids almost a lot of those topics.
Right. Yes.
Yeah.
Yeah. No, the more I learn about it too, and our team learn about it, the more we realize that it really simplifies things if you're going the passive route. So I think we asked this, but can an IRA LLC be incorporated in any state? I think you can answer.
Yes. So it can, if you get a special arrangement. Rocket Dollar always defaults to Colorado, and then we let our customers, they will put their own LLC they really love right below their Colorado one. So we handle all of the IRA stuff. We get that sorted for you. Our customers that want custom jobs will build their own stuff after we give them the Lego set already done.
Will the LPs as an IRA LLC, that's a good one, receive K1s and participate in depreciation?
They do not get you do not get depreciation in a self-directed IRA. So that is one of the many, as you're weighing investment with cash or with a self-directed IRA, it will not get depreciation. So sometimes people ask, well, depreciation is amazing. Why, this sucks. Why would I ever do it in an IRA? And the answer is, to some people, yes, that's unfortunate, but sometimes people, the stock market's done very well. It's been shocking how good it has done this year. I'm not going to try and give investment advice on the webinar here, but sometimes people just say, look, I feel comfortable with real estate in my IRA, and I feel more comfortable than my other investments. I want to be in real estate in my retirement because I feel that my retirement is better served at my risk level and my age in a real estate investment right now. So maybe you miss out on a certain, maybe a certain fund has amazing depreciation and that sucks to lose out, but they look at their current investments and their stocks and their bonds and, the risk level that they're trying to hit. If someone in their 40s, 50s, 60s, sometimes say, hey, I feel more comfortable with real estate, even though I'm losing out on the depreciation.
That makes a ton of sense.
Yeah.
There's three more right now. So what is the advantage of having a second LLC locally?
Yeah, so for a passive fund, often our Colorado LLC will do almost everything for you. If you are an active investor, Rocket Dollar basically recommends that you should get an LLC of a local area, or you should register your Colorado LLC as doing business in the state of So like if you have a Texas investment, if you go into a passive fund in Texas, Colorado LLC is good for you. You don't even need to do anything. You don't need to change anything. However, if you buy a single family home in Texas in your self-directed IRA, it is good to pair the IRA, Colorado LLC bank account, Texas LLC, invest in that asset. Then the state of Texas kind of knows you're a landlord. Your IRA is a landlord in Texas, and they are aware of that. And you're basically running a small business through your IRA. So it's showcasing to the state, the local locality, hey, I'm a local business here. I'm a landlord here. I have everything covered. I've checked all the boxes. It just gives extra protections locally for local laws.
I think there's another question here from Warren, but I think you may have just answered it, but I'll ask it anyway. If I live in California but want to buy investment property in Texas with my LLC, do I still need to pay California taxes?
Yes, you do. And it is very annoying and unfortunate. So the state of California is the only one that operates like this, that just if the person lives in California, they will go out and try and grab that $800 a year from that fee. So the two ways to avoid it: one, you can buy an IRA without an LLC. This is you'll do a deal review. You'll pay our gold pricing. We're kind of continue to make this product more efficient and better for people as well. But you'll get a deal review from our trust company partner. They'll approve the asset and they'll release the funds and they'll get you into the funds. So it's a little bit different structure, but avoids the California fees. And we just rolled that out. It was a great thing, is now you can invest in a limited number of assets on our what we call our California IRA. You can do 20 real estate investments and not pay extra fees for every single time to process those investments. So that's a huge efficiency we just launched this summer. The other solution is if you are self-employed. A lot of people in California, just with the expense of the state, have a side hustle going on. If you're a consultant, if you're your spouse, someone owns a business, you can make a solo K for you and your spouse. And our solo K product does not have an LLC at all. It is a planned document. It's similar to a retirement trust. We appoint you as trustee, and then you have a trust bank account. So instead of an LLC bank account, you have a trust bank account, and you have a mini retirement plan that you can do the same checkbook control investing that we talked about.
We'll do one more question here because I know we're at the top of the hour here. So the question is, who is Rocket Dollar's trustee?
Yeah, so we work with two banking custody partners. So we work with Solera, which is in Lakewood, which is a suburb of Southwest Denver. And just coincidence that they're also in Colorado. They are a banking partner for a lot of checkbook IRAs. Not a household name, but they decided to say, hey, we're going to become specialists and understand exactly how to do these checkbook IRA bank accounts. Unfortunately, Chase and a lot of the major banking partners that people use, they just don't understand what a self-directed IRA is. It's great that Solera understands that very clearly. When it comes to our California IRA, we have a working relationship with Gold Star Trust in Amarillo, Texas. So you could think of them as the old school knowledge, we're the new school tech platform, and we're combining forces to really make that a better product. They are closely affiliated with Happy State Bank. So the answer would be Solera, just outside of Denver, Solera Bank, and then Gold Star Trust in Amarillo, Texas. So Rocket Dollar is helping administer all the parts of the IRA. We are not custodying anything other than the LLC. So the LLC actually owns these assets.
So Brennan, that's excellent. And I want to, for the folks that came into this from the Calterre side, what's the best way of connecting with you and also getting the benefit of that Calterre discount? What's the quickest and easiest way they can connect with the company?
With Rocket Dollar?
Yeah, if they want to.
So info at Rocket Dollar. I'll just bring up rocketdollar.com quick. So you can go and sign up if you want. Click here. You can start to go through the sign up process, and you can use the CalTier code right there at the end. That'll give you $50 off. Info at Rocket Dollar. You can reach me. That'll hit my inbox, and then also the 855 number right here. And we'll get this recording. I think we'll try and get it up on the Rocket Dollar YouTube channel as well. Yeah. So if there's anyone else, you can feel free to share that with your network.
Yeah, excellent. And I just want to say to all the folks that came in on the Calterre side, obviously there are other organizations out there that do similar things to Rocket Dollar. But I will tell you this, from an ease of working and an ease of getting all of your all the process set up, I think they're just one of the, really probably the easiest one that we've come across. And Brendan's fantastic and obviously incredibly knowledgeable. So we're excited to partner with you.
All right, appreciate it, Matt, and love all the education on multifamily today. So we'll close things out. Thank you, everyone, for coming.
Thanks so much. Did you end it?
Yeah.